Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
All right, so today we are tackling one of the most acute points of friction you see in the small cap market. It's the struggle between genuine strategic ambition and the unforgiving reality of a tight cash runway. And we're seeing it play out vividly with Sidus Space, Inc., which is trading under that critical $1 NASDAQ threshold.
Exactly. As of December 18th, 2025, the stock is sitting at around 91 cents. And what makes this so fascinating and frankly so toxic is the market microstructure around it. You're seeing these huge volume figures that suggest massive interest, and yet the price is just stalled. A huge reason for that is this staggering number. 52, almost 53% of all trading volume is happening off exchange, in dark pools.
Right, which brings us to the core tension of our debate today. Is this sub-$1 price a rational reflection of the company's immediate, almost existential liquidity risks and its widening losses, or is it a temporary market dislocation, one caused by, the unavoidable financial burden of the strategic J-curve transition and the extreme technical friction of that off-exchange trading?
And that's the perfect framing. I'll be arguing that the market is acting with brutal rationality here. The price is a direct reflection of the company's precarious financial runway and the looming regulatory and shareholder dilution threats. The market is pricing risk, not potential.
And I'll be taking the opposite view. I'm arguing that the current price is a severe dislocation from the company's intrinsic long-term potential. I think this reflects a technical market ceiling more than it does a fundamental valuation.
Okay, so let's hear it.
My position really rests on this idea that Sidus Space is in a strategic investment valley, what we often call the J-curve. They are very intentionally moving away from their legacy, low-margin contract manufacturing business and pivoting toward high-margin data offerings, the Space as a Service model from the LizzieSat constellation. So that low 91-cent price, that's simply the market penalizing the necessary revenue decline that's inherent in this major operational shift.
A 31% revenue contraction, that's a big pill for the market to swallow.
It's a huge pill, but it's the low point of the J-curve. You have to shed that unprofitable work, which, yes, it hurts the top line while you are simultaneously ramping up investment in the future and the satellites. But look, this thesis isn't just hope, it has a tangible floor. The company just secured a $21 million IDIQ contract with the U.S. Army in late 2025. That shows validated government interest. And on top of that, insider confidence is high. Director Jeffrey Schuman was buying shares back in June 2025 at prices near $1.60. The people with the most information clearly believe the intrinsic value is way higher than where it is now.
Okay, I see why you'd think that. But let me offer a different perspective, one that's centered on immediate survival. The market isn't blind to the future. It's terrified of the next 2 quarters. The Q3 2025 financials, they show an accelerating cash burn rate that is just absolutely unsustainable given the company's current resources. That isn't just slight pressure. That's an explosion in expenses while revenue is plummeting. And if we look at the balance sheet, as of September 30th, 2025, the cash position is only $12.7 million at a $6 million quarterly burn rate. Well, that cash runway is only 2, maybe 3 quarters long. This looming financing overhang in early to mid-2026 creates massive preemptive selling pressure. Every intelligent investor is pricing in the high probability of a severe, painful dilution event. And that 91-cent price, that's just the market's cold calculation of that risk.
Let's actually delve into those Q3 financials, because I think they're really the nexus of our disagreement. You're right to highlight the 31% drop in total revenue, down to $1.3 million. And yes, the market punishes that, especially in a so-called growth stock. But my argument is that this shrinkage was deliberate. It follows management's stated strategy of firing low-value, low-margin legacy customers to free up resources for the SAPS pivot. This is necessary pruning. It's not operational failure.
That's the strategic narrative, I get it. But the operational numbers, they tell a much grimmer story. The punishment is so severe. because the cost structure is completely overwhelming the shrinking income. The cost of revenue metric actually went up substantially to about $2.6 million. This resulted in a gross loss of $1.3 million. I mean, let's be very clear about what a gross loss implies. When a company's cost of revenue is higher than its actual revenue, it is losing money on every single item or service it produces, even before you factor in overhead, R&D, all of that. That is the definition of an unsustainable operation. The market reads that negative gross margin as a failure of operational efficiency during the pivot, no matter how much you dress it up as strategic pruning.
Okay, that's a compelling argument. And on the surface, yes, that negative gross margin it's deeply alarming. However, and this is a really big however, this is where we need to introduce a crucial accounting distinction, one that the market often overlooks or just misprices in a fast-moving, transitioning company. A significant portion of that increase in the cost of revenue, that jump you cited to $2.6 million, is non-cash depreciation and amortization. And this is absolutely critical to understanding the true cash burn. As Sidus launches more LizzieSats and they become operational, those assets get moved on the balance sheet from assets under construction to property, plant, and equipment. At that moment, accounting rules require them to begin depreciating that massive asset cost over its useful life. So this reported depreciation inflates the cost of revenue and that headline $6 million net loss figure, but it doesn't impact the cash burn rate directly. The cash for the satellite was spent long ago. So what it does signal is successful asset deployment. The satellites are now active, ready to collect and sell data. The market is disproportionately penalizing an accounting consequence that actually signals successful strategic execution, not poor cash management.
I understand the difference between cash and non-cash expenses, and it is a good point that the reported loss is optically worse than the true cash burn. But liquidity is what kills companies, not accounting optics. Even if the true cash burn is somewhat lower than the $6 million reported net loss, that cash position is still dangerously thin. $12.7 million provides a minimal safety margin for a company that has to continue R&D, launch more satellites, and maintain its team. And furthermore, market algorithms and most investors, they react violently to that headline net loss figure, regardless of the depreciation nuance.
Okay, fair.
So let's pivot to the second core point, where I think we both agree the dynamics are truly toxic, that market microstructure. I fully acknowledge the friction from the 52.75% off-exchange volume. I'm just not convinced that this friction is the primary cause of the low price. I think it's merely the mechanism of suppression.
See, I'd argue that it is a major, perhaps the dominant contributing factor to this price dislocation below $1. We are talking about a microcap stock with high retail interest. That high rate of internalization by wholesale market makers means that every time a retail investor tries to buy the stock, the market maker just executes the trade off exchange. They absorb the buying pressure internally.
Right.
Think of it this way. For every 100 shares bought by a retail investor, 52 of those shares never hit the public NASDAQ book to contribute to upward price discovery. It acts as a perpetual volatility dampener. It creates that bizarre disconnect where retail investors are screaming the volume is huge, tens of millions of shares traded, but the price is absolutely stalled. This constant technical ceiling prevents momentum from building, and for a stock that's fighting to stay above a psychological and regulatory threshold like $1, that structural friction is decisive. It just obscures the true demand for the stock.
I agree that the friction is real, but it's a symptom of weakness, not the root cause. The low price is fundamentally driven by high short interest. We're seeing 12.3% of the float shorted, which is a very elevated position. The shorts are emboldened by one factor above all others, the extremely tight cash runway. They know the company must finance soon, and when they are forced to sell equity at 91 cents or lower, the dilution will be catastrophic. It will effectively cement that low price. The microstructure merely provides a convenient, low-cost way for those short sellers to operate and suppress small price movements. But the fuel for the short thesis is the impending insolvency risk. It's not market technicals.
But don't you see the perverse effect? The off-exchange volume ensures the stock stays technically weak, which then feeds the short thesis. It's a feedback loop. If the stock were allowed to trade freely on the lit exchange, a price recovery spurred by good news like that IDIQ contract or successful deployments, it would force a short squeeze. It would organically drive the price above $1 and neutralize the regulatory threat. The internalization is preventing the natural price discovery mechanism from actually validating the company's operational shift.
I'm sorry, but I just don't buy that the technical friction is strong enough to counter a fundamentally weak balance sheet. Look at comparable small-cap companies with similar pivots. When the cash runway is this short, even massive retail interest gets overridden by the sheer institutional fear of dilution. If a price recovery was truly imminent based on fundamentals, large institutional investors would be accumulating blocks of shares, and that kind of buying would be far too large for market makers to internalize. It would force the stock higher on the lit exchange anyway. The lack of institutional confidence confirms the market's rational assessment of the risk.
Which leads us directly to the third point, which I agree is the most terrifying for shareholders. This repetition of history and the threat of another regulatory event.
Exactly. History is repeating itself with grim precision. Here we are, late 2025, and the stock is once again below the critical $1 NASDAQ threshold. The looming risk of non-compliance with Rule 5558-2 is the largest single threat hanging over this stock. This regulatory sword of Damocles forces trapped holders, those suffering from severe bag holder fatigue, to sell now. They're exiting to avoid another highly punitive corporate action. We all saw the destruction from the 1-for-100 reverse split in December 2023. That trauma is fresh, and the market is predicting a forced repeat, which makes the current price an inescapable ceiling.
I'm just not convinced by that line of reasoning because the foundational outlook has changed significantly since 2023. You're right, the regulatory risk is real, but unlike 2023, the reverse split back then was an act of desperation. It was for a contract manufacturer facing an expiring cure period with no clear path to profitability. Today, the operational thesis is fundamentally different.
How so?
The company now has deployed assets and a clear path to high-margin revenue through the LYSI-SAT inflection point. And this is where that IDIQ contract is crucial. An IDIQ, indefinite delivery, indefinite quantity, it isn't an immediate revenue check, but it's a multi-year framework agreement with a guaranteed buyer, the U.S. Army. It signals validated technology and a streamlined ability to get high-value task orders. This significantly de-risks future cash flow.
But it doesn't put cash on the balance sheet today.
No, but the threat of delisting would only materialize if the price stays below $1 for an extended period, which I argue is being caused by that temporary technical suppression we discussed. If DAS revenue materializes in force in early 2026 as planned, the price could organically recover above $1, trigger a rally fueled by short covering, and neutralize the threat of more toxic corporate actions. The market is currently applying a distressed discount that completely ignores this validated technology and government backing. It's mistaking a temporary funding valley for permanent failure.
That's a compelling case for the future potential. But have you considered the market's rational doubt about the timeline? The shift to DAS requires a massive leap of faith that this revenue will appear in force before the current $12.7 million in cash runs out, which is likely in Q2 2026. If revenue recognition from the IDIQ is delayed by even 1 quarter, which is common in the space sector, the company is forced to raise capital at these depressed prices. The result is dilution that's exponentially worse because the market cap is so low. High-risk, high-reward plays like this always trade at a high distressed discount until that revenue is physically on the balance sheet, not just promised in a contract.
And that brings us right back to the market friction. The technical structure prevents the price from accurately reflecting the operational milestones that are happening right now. The LYSI-SATs are deployed, the IDIQ contract is secured. The market is struggling to translate those fundamental successes into share price momentum because over half the volume is internalized. It's a structural impairment preventing the market from pricing the transition correctly, and that in turn forces the company closer to the very dilution event everyone fears.
And I still maintain that the microstructure merely provides a convenient mechanism for shorts and liquidity providers to profit against a company with a fundamentally weak short-term balance sheet.
The problem is the cash balance and the accelerating operating loss, not just the trading friction. The market is assessing the probability of insolvency or severe dilution, and it is setting the price accordingly.
This discussion really does illuminate the difficult tightrope walk Sidus Space is undertaking. My argument remains that the price action is a temporary manifestation of this unavoidable investment valley that comes with a profound strategic pivot. The high off-exchange volume and the resulting technical suppression, they obscure the foundational shift toward a high operating leverage model, which is supported by specific government contracts and genuine insider confidence.
In my position is that while, yes, the space as a service model is theoretically superior and the potential is exciting, the immediate reality of a $6 million quarterly net loss and a perilous 2 to 3 quarter cash runway, that overrides technological promise in the unforgiving public market. The 91-cent price is dictated by a rational fear of severe near-term dilution and by the fact that market algorithms punish revenue contraction regardless of the strategic narrative behind it.
So ultimately, Sidus Space is in a genuine race against time. It has to bridge this gap between its legacy manufacturing past and its high-margin data future. The high-risk, high-reward nature of this inflection point is inescapable, and our listeners really have to weigh whether the technological validation and the vision outweighs the immediate financial peril.
Indeed, the key metrics to watch are pretty simple: the verifiable cash balance and the clear recognition of high-margin DAS revenue in the next quarterly report. That's where the ultimate justification for either side of this debate is going to be found, far more definitively than in the volatile daily price fluctuation.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.